Imagine discovering that one of the biggest decisions in your financial life, the choice between dividend stocks and growth stocks, is something most investors get wrong without even realizing it. They think they know what they're buying. They think they understand how each type of stock works. They think they're making smart choices. But what if I told you that the truth about dividend stocks and growth stocks is far deeper, far more surprising, and far more misunderstood than anyone admits? Because today, you're about to learn the part of investing that rarely gets explained. Not the quotes from textbooks, not the cliches on financial TV, not the simple definitions, but the truth. The truth that determines whether your money grows, stalls, or disappears. And once you hear it, you'll never look at investing the same way again. Let's begin with a question. Why do people love dividend stocks so much? The answer sounds obvious. Dividend stocks pay you. They put money in your pocket. They reward you simply for owning them. It feels good watching your account fill up with cash every quarter. It feels reliable. It feels mature. It feels safe. But there's something most investors never stop to consider. When a company pays you a dividend, that money is gone forever, from their hands into yours. And that simple transfer of money reveals the entire truth about dividend investing. Dividend-paying companies are usually large, stable, and past their biggest growth days. They pay dividends because they no longer need every dollar to grow. But here's the hidden truth. Paying a dividend doesn't automatically mean the business is strong. It just means the company has decided that giving away cash is better than investing it back into itself. Sometimes this is smart, but sometimes it's a warning sign. Some companies use dividends as a mask. They use dividends to keep investors happy while the business itself slows down. A company might have a beautiful dividend history while the stock price quietly sinks year after year. The dividend becomes a distraction. Many investors fall for this without realizing it. And here's a question for you. Be honest and drop your answer in the comment section. Would you rather receive a steady dividend from a company that's not growing at all, or no dividend from a company that's doubling in size every few years? Now let's talk about growth stocks. People think growth stocks don't pay dividends because they're too new, too risky, or too unstable. But the truth is completely different. Growth companies don't pay dividends because they're reinvesting every dollar into becoming stronger and bigger. They are building new products, entering new markets, hiring new talent, creating new technology. They don't want to give money away because they can use that money to grow your investment. Growth stocks are the reason some investors retire wealthy. They're the reason some portfolios explode in value. But they also come with emotional challenges. Growth stocks move fast, up and down. They test your patience. They test your confidence. They test how you react when the market gets shaky. And that's why not everyone can hold them long enough to enjoy the reward. Here's a question to think about. Would you be able to hold a stock that dropped 30%, even if you believed in its long-term potential? Share your thoughts below. The biggest truth most investors never understand is this. Dividend investing is not safer, and growth investing is not riskier. Both have risks. Both have benefits. Both have weaknesses. The difference is psychological. Dividend stocks reward you with small, frequent wins. Growth stocks reward you with bigger, less frequent wins. Which style fits your personality? This is where most investors go wrong. They choose a strategy based on popularity, not personality. They follow what someone else said on the internet. They copy a strategy that works for someone else, not realizing that the strategy only works because it matches that person's emotional tolerance. The best investment strategy is the one that fits your emotions, your goals, and your time horizon. Imagine two investors. One chooses dividend stocks, the other chooses growth stocks. 10 years later, both could be right or wrong. It all depends on how consistently they stuck to their strategy. Consistency is more powerful than dividends or growth. It's more powerful than strategy. It's more powerful than market timing. Consistency is what separates successful investors from frustrated ones. Let's go deeper into the psychology behind these two styles. Dividend investors love stability. They enjoy seeing regular income hit their account. It makes them feel rewarded. It makes the stock feel real. Even when the stock price goes up or down, the dividend feels like a promise that the company still values them. That's why dividend stocks attract people who want peace of mind. Growth investors, on the other hand, live on a different emotional wavelength. They don't need the company to pay them cash today. They want the company to grow big enough that the stock becomes worth far more tomorrow. They're betting on future expansion, future innovation, future dominance. This mindset attracts people who are patient, forward-looking, and comfortable with uncertainty. Here's something most people never think about. Dividend investing rewards you for the present. Growth investing rewards you for the future. Which one feels more natural to you? Which one matches your personality? Leave your answer in the comment section. But there's another truth almost no one talks about. You don't have to choose. The debate between dividend and growth stocks is often presented as an either-or decision. But the smartest investors combine both. They use growth stocks to increase their wealth. They use dividend stocks to stabilize and protect that wealth. Growth builds the mountain. Dividends maintain the mountain. You can blend the two strategies based on your age, your goals, and your tolerance for risk. Ask yourself, what percentage of your portfolio should be in growth stocks, and what percentage should be in dividend stocks? There's no perfect answer. Only the answer that fits you. If you're still watching and enjoying, be sure to like, subscribe, and share this video for more amazing content. It helps us keep creating videos like this for you. Now let's go even deeper into the hidden truth. Many investors misunderstand what dividends actually represent. When a company pays you a dividend, its stock price usually drops by the same amount. If the company pays a $1 dividend, the stock price typically adjusts downward by $1. Most new investors don't realize this. They think the dividend is free money. But it's not free. It's coming out of the company's value. This is why understanding the business is more important than chasing high dividends. Here's something important. A high dividend yield can be a sign of danger. A company might have a high yield because its stock price is falling dramatically. A falling stock price can make a dividend look attractive even when the business is struggling. That's why experienced investors always ask one question. Can this company keep paying its dividend for the next 10 years? Growth stocks have their own hidden danger. Some companies call themselves growth companies simply because they don't pay dividends. But not paying dividends doesn't automatically make them good. A true growth company has strong profits, rising revenues, and a clear vision of expansion. A fake growth company simply reinvests because it has no other choice. So the real question is the company growing because it's strong or because it's struggling to survive? The truth most investors don't know is that dividend investing and growth investing are not about the labels. They're about the quality of the business behind the label. A weak company paying dividends is not safer than a strong company reinvesting profits. A risky growth company is not better just because it's exciting. What really matters is whether the company is financially healthy, well-managed, and positioned for the future. So here's the ultimate question, one of the most important investment questions you'll ever answer. Are you building an income stream, or are you building long-term wealth? And which one do you need more right now? Think about it. Then drop your answer in the comments. One last thought before we end. The world of investing has two types of people, those who chase strategies and those who build strategies. Those who chase try everything. They jump from dividend stocks to growth stocks to options to crypto. They are always searching for the perfect approach. But the truth is that no perfect approach exists. The real winners are the ones who pick a strategy, learn it deeply, understand its strengths and weaknesses, and stick to it long enough to experience its rewards. Now that you know the real truth behind dividend stocks and growth stocks, which investor do you want to be? And more importantly, what kind of future are you building with your choices today? Leave your answer in the comment section. I'm excited to read your thoughts.